Welcome to the NISM Masterclass. I am your host Sashi Krishnan. Our purpose at NISM is capacity building for the securities market ecosystem, and as part of that purpose we sit down with the gurus of the securities markets to understand from their journey and get insights into the market. And my guest today is Gesu Kaushal, and Gesu is the Managing Director and Co-Head Equity Corporate Finance at Kotak Investment Banking. And Gesu has over 3 decades experience in the investment banking space, and she has a very deep understanding of the Indian capital markets and has led fundraising across multiple sectors. And interestingly, she was also the chairperson of the Board of Association of Investment Bankers of India and has also been on multiple committees set up by the Securities and Exchange Board. And welcome to this masterclass, Gesu, and thank you for sparing time.
Thank you so much, sir. It's a pleasure to be here, and I'm grateful to you for having thought of me. I love watching a lot of your masterclasses, and yes, I'm glad I'm here.
So, Gesu, if you look at the primary market space, there's been a lot of action over the last couple of years. Like if you look at the FY 22-26 period, almost 71 lakh crores of capital was raised through debt and equity from the primary markets. And if you look at the current year, 25-26, we've had a whole spate of, initial public offerings and, raisings from the capital markets. I think something like close to 2 lakh crores of capital has been raised from the market as per the statistics I saw which the NSE put out. And out of that, something like 64,363 crores was IPO. So it would be very interesting for us to understand right at the outset as to how critical is the role of the primary market in fueling capital formation and supporting economic development.
Sure, sir. I think let's look at it as 2 constituents who contribute to this capital raising.
Right.
One, of course, is the issuers, and the other leg is the investors.
Right.
From an issuer standpoint, the ability to raise money from public markets to list their securities has multiple benefits, both for themselves as well as the economy as a whole. Of course, it leads to capital formation for the issuers. It leads to formalization of the economy, right? More and more companies are able to list legitimately and attract investors is a very good sign of formalization of the economy. That itself has a multiplier effect. Job creation is another big upside. There's wealth creation for the employees, for the companies per se, and their ability to scale and develop products and services that, of course, this big large nation needs, and to do it more efficiently, right? So that there's a multiplier effect as far as the economy is concerned. If we look at the investor standpoint, allocation of capital, using their savings to be able to make investments and earn returns, so right. Put money to work.
Right.
Of course, it gives them a social status and a boost to or supplement their earnings. So I think both constituents benefit greatly with capital markets, and I think we've seen that very decisively over the last 10-15 years in the Indian context, and we've seen larger IPOs happening, and so it's a very...
So it sort of democratizes participation in the markets from the issuer's perspective.
Of course, sir. Yes, more investors come in, more informed investors come in. There is a multiplier effect in that sense, right? 5 people invest, then another 5 invest because they've made money. Right. So yes.
So it's very important, as you just said, for issuers to access capital, and obviously the public markets is one place where they can access market. But when they go to public markets, the first time they go, if they intend to list, obviously they use the IPO route. But subsequently, they can raise money from public markets through an FPO, or they could raise money through a rights offer, or through a preferential offer, or through a QIP. There are multiple ways in which they can raise money from, the capital markets or the primary markets. And if you look at that 2 lakh crores, which I was talking to you about, say around 64,000 crores or odd would have been what came through IPOs, and the rest of it actually came in through preferential offers and QIPs and a little bit through rights issues. So how does an issuer decide as to what is the best way to sort of access the market, which sort of route is the best route to access these markets?
So, sir, there are different types of companies in the market, right? There are some which are capital intensive,
Right.
some are services really.
Right.
So, let us look at, for example, banking and NBFCs. Now, their core business is lending.
Right.
And they need capital to lend,
Right.
So they raise capital, they leverage that, and then they lend.
Right.
So if you'd see cyclically every 5 years or 6 years, we would have a bank or an NBFC raise capital, fresh
Correct.
capital.
Right.
Now, like you said, there are different routes to do it. One is, of course, the QIP route, which is mostly institutional investors. The FPO route is akin to an IPO, where you also have retail investors participate.
Right.
Rights issues from your existing shareholders. So, as far as the efficiency of the process is concerned, I think the QIP process is the most efficient, because it attracts new investors. It could also have existing investors. There are pricing regulations around it.
So, in QIPs, the investor is more informed.
It's an informed investor, because these are all institutional investors.
Right. Okay.
And they can put large amounts of money
Right.
to invest.
Correct.
FPO is a good route, but again it's a little bit more expensive route.
Right.
There's free pricing in an FPO. So if an issuer wants to target a large investor base, then
Right.
they should look at their rights issue route or an FPO route.
Right.
Reliance did it. Yes Bank did an FPO. Reliance did a rights issue.
Right.
There are several rights issues from the Mahindra Group, often. So, different issuers may have different needs. One could be just raising capital, one could be, if you have a large shareholder base, then why don't you go to them and do a rights issue?
Right.
If you want to attract new investors into your fold, then a QIP is a more efficient, quicker process. All of them need offer documents, all of them need, marketing.
A set of disclosures that need to be made.
Yes.
And,
disclosures and effort to raise capital, shareholder
okay.
approvals and board approvals, etc.
So, it's more of, what the issuer thinks is the best way to access the market that, sort of makes him decide as to, whether you should use this route or that route.
Now, also look at a bank maybe, without taking names, who is getting a strategic interest from an investor.
Correct.
Then instead of doing a wide product of a QIP, you do a preferential issue.
Right. In fact, a large amount of money actually now is being raised through preferential issues.
Yes,
right?
because there's a strategic investor, which could be financial investor or strategic investor. It could be the promoter wants to invest money without really having to go to many new shareholders. Then a preferential is a very efficient route.
So, in the current year, for example, almost 60,000 crores has come in through preferential issues.
That's right, sir.
And almost the same amount has come in through the IPOs.
Through
so,
IPOs.
a lot of people do choose it if they want to get in strategic investments.
That's right. That's right.
Okay. And what about, the fact that when a company decides to go public, the investment banker actually plays a very, very key role in this whole thing. In fact, as I keep saying that, the trust has been outsourced to the investment banker. I mean, he is the person or she is the person who sort of actually is the, to whom the sort of the person who is applying for an IPO looks to ensure that, everything is above board. And, whether it is in terms of timing of the issue, the structure of the issue, the regulatory compliance, preparation of documents, valuation, marketing, everything is the responsibility of the investment banker. And I wanted to get you to answer a couple of questions on all these issues. But I think the most important thing which, an investment banker is tasked with is due diligence. And, this could be financial due diligence, it could be legal due diligence, it could be operational due diligence. But I think due diligence becomes a very important part of what the investment banker is required to do. So, can you just quickly take us through that, the due diligence process that you do when you, go in to sort of advise an IPO?
Right. So, like you rightly said, due diligence becomes the core tenet for preparation of the offer document, for getting the issuer to explain everything that they've been going through and what the business prospects are in a concise manner.
Right.
I think the three pillars of due diligence, and you kind of alluded to that, is one is financial due diligence.
Right.
What is important here is who are your auditors, how have your, financial records been maintained, how do you maintain your MIS, and I'm talking about the company here.
Right.
Does the processes and the requirements that the law has set forth and the accounting standards have set forth, are they in order? Do you have risk management processes that are adequate with your size and heft in the business? So financial is of course very important. Do you have auditor qualifications in the past? How have they been addressed? Do you have an active audit committee? Are you going to set up one? Who your auditor is, and how you deal with it. Do you have many different auditors for subsidiaries, or everything is done by one audit? So these become questions relevant for financial due diligence. The second aspect is legal. Legal is, do you have business approvals in place? How do you approach business approvals? If you're a business with many retail chains, suppose you were a restaurant business.
Right.
Do you have safety approvals, fire approvals, the food?
So as an investment banker, you need to go and check each one of those things?
So what we do is we ask the company for all their approvals. We ask for MIS.
Right.
We go through and check whether, suppose they had 230 outlets,
Right.
whether all of them had A, B and C approvals.
Okay.
If they didn't, when did they apply for it? Suppose the company is of a smaller size, or they don't have a team that does this, or they have not really paid attention to it. IPO is a very good time to put the house in order.
Okay.
And we call it that, saying, okay, these 30 units, you've not sought an approval for 3 years, it's expired, please go ahead and apply for this approval.
Right.
If it's material, try and get it before we actually file the offer document. So yes, leases, property that is it owned, is it leased? Many times there are cases or income tax cases that have just been missed, so to say. But the minute you start shining a light on all of these things, then the issuer kind of takes steps to either make corrections. Sometimes it could be an ROC compounding that was missed. People change in companies. Unlisted companies need not attract the best talent in that sense. So I'm just saying that a lot of the times an IPO process is used to bring the house up to speed, and from there on, of course, there is no looking back.
So you almost are doing a job of a business consultant at that point.
Yes, so sometimes it does happen like that.
To ensure that you're sort of making them IPO ready.
That's right, sir. And sometimes companies could have pre-existing private equity investors. Then the situation is slightly different, because there's already been rounds of diligence, there's been some kind of oversight from a third party that's already happening. We notice a different mindset in such companies. So, all types of companies do plan IPOs. It has happened, and it does happen, that sometimes you tell them, look, you're not prepared yet.
Okay.
How you need to give quarterly results after listing. Now, if you're going to take 9 months to prepare your financials, then that's not cool.
Right.
Please, maybe make your team larger, employ get advice, come up to speed, and then think of doing an IPO. So yeah, and the third, I think, and very critical aspect is the business diligence.
Right.
Business diligence entails not just data, so products, services, how do they sell it, what's their strategy of growth, how have they grown in the past. They took 20 years to get here. How will they reach twice this size in 2 years? May not be possible. So understand strategy, quiz them, question them, compare them with other companies, because we have sector experts within investment banks who understand and deep dive sectors.
Right.
What is your geographical growth? Will you face competition? How do you deal with competition? Is there going to be a regulatory change that might come in this aspect of the business? How do global markets deal with products and services like this? Why is this unique to India and therefore a good deal versus why it didn't work in China? Or vice versa, it worked in China or US but may not work in India.
Right.
So a lot of detailed questions. Is your business seasonal? How do you deal with seasonality? So things like that. Have you made mistakes in the past, and how have you course corrected?
Right.
And is the promoter or the founder or the management committed to understanding that these changes will happen? They need to be, they need to be thoughtful about how they project or process disclosures in the offer document.
So do all these business aspects need to be discussed in the DHRP and in the offer document?
So yes, 100% everything gets discussed and disclosed, which is why you see very lengthy risk factors.
Right.
Okay. So risk factors would cover the fact that, oh, we did not have approvals for 30 units or 30 branches, and the company has applied for these approvals.
Oh, so you need to make that disclosure.
So we make that disclosure. We will make a disclosure that so many of these offices or properties are on lease land and not on owned land.
Right. Okay.
So there could be a risk that you have a front side very happening retail business, and the lease is expiring in 6 months.
Okay.
And
so you need to make disclosures to that level of detail.
That level of detail.
Okay.
And that's the due diligence we will also do. That look, you have taken this property from Gesu Kaushal.
Right.
This is your most happening property.
Right.
What if Gesu does not renew your lease after 6 months?
Right. Okay.
And if she renews it, what if she asks for more money? Right. So I think those kind of things are all discussed in detail and disclosed in somewhere out of those 500 pages.
Right. So when you need to complete this due diligence process, it's a very intense process, and when a company is going first time to the market, obviously, many of these things will not be in place. So how long does this process take normally?
The fastest we could have done is about 3 months to 4 months, and it does sometimes take longer. Takes longer.
Okay. So the other question I wanted to ask you was that after you have done your due diligence, obviously you come to structuring the issue. So, there is a process that would be involved in deciding on the issue size, on whether it should be a fresh issue or an offer for sale, because many of the private investors have already gotten prior to the company IPOing, or it could be a combination of both. So there would be a ratio that there would be some give and take, saying so much offer for sale, so much fresh capital. Then there will be reservations that you will need to make for retail investors, for employees, for institutional investors. Who should be the anchor investors? I mean, obviously that becomes a very important part because it does lend credibility to the issue. So could you please explain, as an investment banker, how do you go about structuring the issue?
So in fact, when we start work on an IPO, the first question is, does the company need money?
Okay.
Or is this going to be an offer for sale?
Right.
And by experience and based on the sector the company is in, so there could be a situation that a large acquisition has recently been made,
right,
which has been funded by debt.
Right.
So yes, the company would want to delever,
right,
would want to raise equity funds to be able to repay that debt.
Correct.
That's a simple thing. If it's an NBFC or a bank, you would more often than not see a large primary issuance,
right,
because again growth comes from ability to raise capital and
right,
onward lend. Manufacturing is a little bit easier also. So each situation is somewhat different. The complication happens. The first thing we need to make sure is that we are meeting the minimum dilution requirements.
Correct.
Right. Now, if the primary issue is not taking us there, then we need to have also an offer for sale. Again, in the offer for sale, there are different considerations. An investor who's been in long may want to sell,
right,
whereas an investor who's recently come in may not want to sell.
Correct.
So that would determine also how much offer for sale.
Right.
Sometimes there are 10 or 15 investors on the cap table.
Right.
Now, one may be willing to sell, the other 14 may not.
Right.
Or nobody may be willing to sell. Then you say, okay, no, I need 5% secondary. Everybody give 5% of your shares as secondary.
Okay.
So it really also depends on the relationship between the issuer and their shareholders. It depends on like I said, the tenure of how long the investors have been in the company.
The promoters could also offer shares.
Promoters may have to offer for sale to meet 10% dilution if others are not willing
right,
to.
Right.
Also, sir, post IPO there's a lock-in.
Right.
Right. So promoter may be locked in for 18 months if there's no capex, or 3 years. They may want some liquidity now.
Right.
So they may themselves add on to the OFS.
Correct.
So it is again like no cookie cutter approach. It is very specific to that transaction and the facts of that matter.
Right.
But like I said, the dilution usually is kept between 10 and 20 odd percent, so that there's a successful IPO with which attracts a wide variety of investors in its fold.
But the market would also influence a lot of the thinking that goes in, because you have to gauge investor appetite, you will have to look at the valuation environment, you will have to look at market conditions. Very often we've seen markets have been, not very, very buoyant, and therefore, both the promoters and, the other investors may not want to offer for sale at that point of time. So how important is the market environment while taking these calls?
No, very important. In fact, taxation also plays a role, right?
Okay.
If there's a secondary, like short-term capital gains tax versus long-term capital gains tax.
Right.
So seller who's selling in the IPO,
right.
which is an unlisted security, if they've been only in for 1 year,
right.
then they have to pay a large tax.
Short-term capital gains.
So they may not be interested.
Right.
We see that with promoters also. Sometimes promoters have put in some money afresh,
right.
then they don't want to offer for sale.
Correct.
Also, the consideration is how large is the IPO size.
Right.
So it should be large enough to attract large investors.
Right.
But it shouldn't be too large that you need 100 investors to invest in that IPO, right? Like in the sense that dilution is kept in a range which is reasonable.
So let me interrupt you here and ask you, how do you then determine what is the appropriate IPO size?
So like I said, the boundary is between 10 and 20% usually.
Right.
We also know that if it's a 100% promoter-led company, the company has to achieve 25% public shareholding within 3 years, right?
Correct.
Or whatever the rules are
Right.
that are currently in force.
Right.
So if it's a 100% promoter entity, we tell them don't do only 10%. Do a slightly larger size, otherwise there's too much overhang.
Right.
Because you have to dilute from 10 to 25, which is twice this size.
Right.
Within 3 years, and markets can go up and down.
Right.
Your business can go, cyclical. So do a little bit more. So get close to 20, so that you don't have a big tail left.
Right.
If it is a smaller company, you would say, okay, go as much as possible, because if you have a larger IPO size, then you attract bigger investors.
Right.
So the decision, like I said, is between 10 and 20% usually.
But if you raise too much capital, then you tend to dilute earnings also, isn't it?
That's correct, which
So
is
that-
why secondaries help. So you
Right.
keep the primary size raising money for more than 3 years.
Okay.
So typically we kind of estimate the requirements of the company over the next 3 years and raise primary only to meet those requirements rather than more long term.
Right. Okay.
So that, and we tell the companies you can come back and do a QIP, you can raise money through a rights issue subsequently, but let's not take money from public investors now for a very long period, because there's a lot of monitoring involved and dynamics of the market change.
So in this process, the other question I wanted to ask you was, how do investment bankers manage the book building and the book running process? Because there has to be some give and take between what the issuer's expectation is in terms of, what he sees as a fair price, and, what is the market clearing or demand-based price discovery that happens through book building, etc. So that becomes a very important process. And could you quickly, tell me how does that happen? Because that I think at the end of the day is something that would be, very, very important both for both the issuers and, prospective investors in the company.
Sure, that's I think the heart of an offering
Right.
in general.
Right.
So once the document is public,
Right.
at that stage there are institutional meetings that take place
Right.
between the issuer and the investors.
Okay.
Of course, these are short meetings, not more than 45 minutes to an hour, but it's basically an opportunity for the issuer to explain to a potential investor,
Right.
and an informed investor, I may add, on what the business is all about, what drives them, what the passion is. So the offer document that you see kind of summarized in 20 slides or 30 slides
Right.
is what is explained to the investors.
Right.
Investors have the offer document handy with them. They are in the market, they know what other companies are doing, okay? They know, they have good views, they have research, they have access to research of other banks, they have access to their own research,
Right.
they have a worldview, they meet many companies on a daily basis. They then analyze this information and form a judgment.
Right.
In this whole process, the banks are very important, because the investor then liaises with the banks, not the issuer.
Right.
And the investor and the investment banker and the investor then have conversations across the table So if there are 20 investors or 30 investors that are key, then there are 3 banks in the thing. You will have a conversation saying, okay, these 5 investors are thinking of valuation on this basis.
Right.
Which is, okay, when you're valuing Hyundai, you're looking at Maruti and Mahindra and Tata Motors.
Right.
And you're willing to give a similar multiple, a higher multiple or lower multiple, depending on the facts of, this offering,
right.
So to say. So those conversations take about 10 days, 12 days, 15 days.
Right.
And between the banks, there's a consensus view then, look, we need to raise 5,000 crores. We think these 30 investors are interested, and this is where the price will clear. We take that information back to the issuer, and we give them a judgment.
Right.
Now, there can be 2 outcomes or 3 outcomes. One reaction can be, no, this seems very far off from what we expected.
Right.
And therefore, we want to wait a quarter or 2 quarters and therefore defer the deal.
Okay.
The other can be.
And this is after all the due diligence and the
offer
DHRP,
document
everything
is in public
done.
domain, it has been made, it is out there,
Okay.
yes.
Okay.
The deals get deferred
Okay.
sometimes. The other reaction could be, oh wow, this is great, this is exactly where we were. And the third can be.
So there is a convergence.
There is a convergence,
between
yes.
what the issuer is expecting and what the potential investors think
are
is
thinking,
it's worth.
yes, thinking
Okay.
or guiding or.
All right.
It is possible that there is, like in the first situation, I said, no, this is too far off, we are not willing to
Right.
sell at this price. Then you have to redo the process 2 quarters out.
Correct.
So there can also be a debate between timing and pricing.
Okay. And the cost of
At the cost of
doing
deferring.
deferring
At the
it.
cost of, yeah.
Right.
So many times we see issuers are prudent. They want to get back to their business lives,
Yeah.
not to be distracted with the IPO process, and they pick and move on.
Okay.
Sometimes, sir, in this process of, the 6, 8, 10-month process, there's a regulatory change.
Right.
There is US tariff, there's uncertainty about another global situation
Right.
or a domestic situation. There we don't even go down the path of going to investors and spending time because we know what they will say. There's uncertainty.
Right.
And then you just kind of quietly defer the deal.
Okay. So without even looking to sort of go through a book building process.
Yes, that happens sometimes.
Okay, so just a question that I had out here. What if there is, a very wide difference between the potential investors,
The views of
the
pricing.
views of potential investors in terms of pricing? Then how does an investment banker resolve that?
So, finally.
I know it could happen very rarely because,
It does happen sometimes, yes. So there could be, through experience, we also know whether the investor is giving genuine feedback or it's a negotiation position. Sometimes they are okay to be convinced to go up a little bit.
Right.
However, it is important to clear the deal.
Right.
And nobody wants to put the issuer or the issue at risk.
Right.
That, okay, we have 50% demand, the rest 50 will come somehow. No. That chance is at least the banks don't like to take,
Right.
and the issuer will not like to be exposed to that.
Right.
So if it does mean that we need to price it in a manner that gets the volume of investors in, then that's the advice the banks will give, which is, look, if you want to do the deal now, then take let's just go ahead at this price, which could be the lower of the view we are getting.
Okay.
Yeah.
So the post that, obviously there is a whole lot of work that investment bankers need to do in terms of marketing the issue, to do road shows for domestic investors and for foreign investors. Obviously the institutional investors to a great extent have some idea already as to what the fundamentals of this company that is IPOing is all about. You need to build market interests among HNIs, retail investors, etc. So what are the challenges out there? But more importantly, how do you ensure that there is no asymmetry of information? Because every constituent, whether he's an institutional investor or a HNI or a retail investor or a domestic investor or an international investor, needs access to the same information that is available to everyone else. So that, I think, is a very important role that an investment banker needs to fulfill.
Yes, I think from the beginning of this process, the key thing that is told time and again to issuers, and of course the banks know this, is that the Bible is the offer document.
Right.
And please stick to this. Everything that we wanted to communicate to investors is included in this.
Right.
Now, the industry outlook, for example,
Right.
the regulatory environment, for example, what the competitors are, who they are, what are they doing, how do their business stack up vis-a-vis us, of course, our own business risks, what is the business strategy? There's a section in the offer document on strategy, which may not have concrete numbers because you can't make projections,
Correct.
but it does directionally give a fair idea of doing more of the same thing, doing new things, and what are the levers for growth going forward, which is all in the offer document, which the précis of which is what is communicated with investors in 1 meeting, 2 meetings, or even 3 meetings. Right. The only difference between a retail investor and an institutional investor is not information, but the ability of the sophisticated investor to process that information.
Right. Correct.
Right? And to have other means and sources to corroborate the information, to deny it, or to challenge it, right? So, like I said, parity of information is non-negotiable. It is something that we work very hard to make sure that everybody gets the same information to process before making an investing decision. The marketing process, yes, for institutional investors is a little bit more in-depth, intense, yeah, and over a few days, whereas the way to reach retail investors is through the broker community,
right,
through the media community,
right,
and through the wealth managers if it's HNIs. So, because you can't meet so many investors, you find ways to communicate with them through intermediaries. And also now we have a formal audio-visual presentation that's put up on the website. Right. There's of course the offer document. There's a lot of Twitter discussion, social media discussion.
So there's a lot of information available to every class of investor.
Absolutely.
And all the information is available.
And similar information is available.
So there was a question I asked you a little a few minutes back about anchor investors, because right, how do you decide which of the institutional investors you would take on into your anchor book?
So sir, the philosophy of anchor investors actually came in 2009.
Okay.
And till that time, or for a few years till that time, allocation to QIBs was proportionate.
Proportionate, yeah.
And this was when the market had global markets had melted, and it was very difficult to price offerings, right, because investors would say, "Theek hai, we will see, we'll come into the book, and we know we'll get proportionate allotment. Right. So there's no need to do anything right now. There'll be no indications given." And that's when we worked with the regulator and created this concept of anchor, to basically bring in investors who show their hand early, right, to give a decisive view on valuation size, right, and in return they get discretionary allocation.
Okay.
Okay, it's sounding like a transaction, but it's not. It's like you help build the book.
Right.
You come in early, give a view on your interest and guidance. We get other investors in.
Right.
And therefore you get a sizable investment, chosen investment, but you have to be locked in.
Okay.
So the counterbalance was, so they gave something to the offering gave back allocation. Then because you got more allocation, or you got allocation you wanted, you lock in for 30 days or 90 days depending on the size.
So what the anchor investor is doing is he's only making a commitment at that point of time.
He's making a commitment, and he's
giving
he's
us confidence
to price. No, he will put money on the table.
He will put money on the table, right?
Yes.
that is the expectation.
And sir, this is a perfect market in that sense, right? If you commit to make an investment and you don't do it in deal A, then in deal B your commitment will have less value.
Correct.
So when you're making the commitment, you're conscious that you are in this market for the long term, and therefore your commitment means something.
Okay.
So we've not had that concern at all. Also, the other thing that anchor does not get is ability to reprice.
Right.
So for example, you showed your hand at 100 rupees.
Right.
My price band is 95 to 100.
Right.
And you came in at 100 the day before the issue opened.
Right.
And something happens to the market or the world.
Right.
I'm forced to price the deal at 95.
Right.
You still stay at 100
as
an anchor investor.
Okay.
So you're not able to get the benefit of 95 rupees or 96 rupees, whatever the final pricing is. So it's worked out well for the Indian markets. It has given issuers confidence and investment bankers confidence to launch deals on the back of QIB investors who take anchor positions.
So there have been a few issues in the past where, some discounts have been given to retail investors over the discovered price.
Yes.
So that can also be done in an IPO process?
Yes, there is a discount possible, both for retail investors as well as employees, if there's a reservation.
And employees, yeah.
And some companies also have retail shareholders in their group companies or other entities.
Correct, right.
So you could give a discount to those.
Okay, and those are all pre-decided and disclosed upfront in the offer document, or this is after the price has been discovered?
So if the company does seek to make reservations, we disclose it.
Okay.
That we will reserve for employees, we will reserve for all these other categories. We may not decide the quantum right up front.
Right.
The pricing discounts are disclosed when the price band is disclosed, which is when we are about to launch.
When you are about to launch, okay. So, talking about allocation and listing, right, can you just quickly tell us how do you determine the allocation rules? I know there is anyway certain standard rules for certain categories of investors. The second question I had out here was that the IPO timelines are very tight now. Like for example, you need to finalize your allotment in T+1. You need to ensure that it is credited to the demat accounts in T+2. You need to ensure that it is listed on T+3. And so that was the second question. How do you manage such tight timelines, given the fact that the volumes are very, very large? Not only in terms of the number of investors, but also the issue size is also becoming very, very large nowadays. And the third question, as far as allocation and the listing process is concerned, I wanted to ask you about, a little bit about, the pre-opening session on listing day and, the normal trading. I mean, how does that process happen?
Okay. So the first question, sir, was about how allocations are done.
How allocations are done.
So other than anchor, everything else is pure proportionate.
Okay.
So QIB, suppose the QIB portion is subscribed 5 times, all investors who are valid will get 1/5 the amount they invested.
Okay.
When we come to the retail bucket, while it's proportionate, the methodology is slightly different.
Right.
Wherein first you clear everybody at the first bid lot, then if anything is left, you give more. So suppose you and I both invested in the retail portion, I put in 15,000 rupees, you put in 2 lakh rupees, which is your cap. First, you and I both will get 15,000 rupees worth of allotment.
Right.
And all of us will get 15,000 worth. Now, if there's still shares left, then you could be considered.
Right.
For anywhere between 15,000 and 2 lakh rupees.
Correct.
So it's more democratized at the lowest end of the bid lot. The same methodology is followed for HNI, where 2 lakhs becomes the base in one case category and 10 lakhs in another category. But it's proportionate in the sense there's no way to pick and choose, give allocation to A and not to B.
Okay.
The timelines have been significantly made more efficient.
Right.
And there are 2 legs of this. One, of course, all bids have to be paid bids. So money has to come in upfront.
Right.
Right. And for that, we have used the entire banking network, the UPI, infrastructure, and made sure that the bidding process is super efficient. We have NPCI, we have the stock exchanges, we have the many, many brokers, we have the many, many banks.
Right.
They all get involved as a very, very straightforward, simple process that we have to follow. I won't call it simple, but now everyone's used to it.
Right.
So the entry point of bids with the money has been streamlined.
Right.
And that has given the regulator and the market confidence that yes, allotment can be made within 3 days.
Right.
Again, it's all electronic. Take the large set of bids, check for, reasons for rejection. Reasons of rejection could be money is not received, which is unlikely. It could be multiple bids. You erroneously made 3 bids, or you made 3 bids on purpose, so you have to be weeded out. Your PAN and demat account don't match. So some of those things, you take the 100 bids, you clean it up and make it 80.
Right.
And from here, now it's the formula that we have to apply, which is electronic.
So this entire process is now digital. Like
digital.
The technology helps you to clean up the book, helps you to sort of do the
Yes.
allocation.
And we learn from market experience, right? Now, if 3 large offerings are open at the same time,
Right.
then the volume of this whole UPI
Right.
blocking of money, where the forms are moving, etc., becomes very, very critical.
Right.
So the stock exchanges, the registrar, the investment bankers, SEBI, all of us are hawk-eyed to make sure there are no glitches. And there are redundancies set up in the system to make sure if there's a little glitch noticed, divert volumes so that it's glitch free.
Yeah.
And
So,
we learn from
so
experience.
ASBA was also a very big enabler of this entire process, isn't
Yes.
it?
No, ASBA helped. So when I started work, sir, allotment used to take 72 days.
Okay, 72 days.
Yeah, listing used to take 72 days.
Okay, and now we're talking about 3 days.
3 days,
My
yes.
goodness, okay.
And one of the big things that changed about 15 years back was this introduction of ASBA. Why can't we block money in the investor's account without having to move it from here to there?
Right.
And that movement was taking clearing time, etc., etc. This is pre-UPI days and
Right.
pre-digital
Right.
settlement days.
Right.
So ASBA helped keep your money in your bank account, but blocked for this IPO.
Right.
And that removed a lot of time from the process.
And the third question I had was about the trading,
trading.
the listing day and the pre-open session.
Sure. So, sir, while the stock market opens around 9:15 in the morning every day, for IPOs, the listing starts at 10 a.m.
Right.
Okay. So, what happens is between 9:15 and 9:50, people put buy orders and sell orders because some have got allotments, some want more, some want to sell, etc., etc.
Right.
And those are aggregated to determine the pre-open price.
Okay.
So, at about 9:50, crucially around that time is when the pre-open market price for that stock is given, and that becomes the price to determine intraday
Margining
margin
and all that
and
stuff.
everything.
Okay.
Yes.
Right. So I just wanted to ask you a question about the issue of capital and disclosure requirements regulations, and how has it evolved over time? Because the regulations today require a lot of enhanced disclosures, especially from promoters and issuers in terms of the transaction prices, the kind of interrelated party transaction details that they need to do. Similarly, in terms of track record, profitability, there are some actually now minimum eligibility requirements. So can you just quickly take me through some of the regulatory enhancements that have happened, especially given the fact that you've been part of a lot of these committees which the regulator has set up?
So when we go back in time in the late 90s, an offer document used to be 30, 40 pages.
Right.
And then SEBI guidelines for disclosure and investor protection used to come in the form of circulars.
Right.
So we would keep adding to the book of circulars. I think in 2009 is when the regulations came into being.
Right.
So that they have a regulatory heft and ability for SEBI to go after non-disclosures. They have been enhanced with time in tandem with the listing regulations also. If you notice that the ICDR is the entry point regulations and LODR is the ongoing regulations.
Correct.
So we have done a great job as a nation to align them in that sense to determine and identify material information that needs to be available. Also, if you recall, there was a phase when there were a lot of FII interests. We were also doing book building, which started in 2000, 2001. We learned a lot from how international deals were being done, particularly in the US or Hong Kong or Singapore. We picked up aspects of disclosure from them. For example, the whole management discussion and analysis of the financial performance is a bulky chapter now, very crucial and very important, but a lot of the foundation of that chapter is how US transactions would describe their financial performance.
Okay.
Now that's formed a part of our ICDR, that's now also part of Companies Act and LODR requirements.
Right.
So disclosures have, actually if you ask me, there has been no static disclosure requirement. We make a regulation collectively as a team, of course led by SEBI. We realize that this this is causing some difficulty, but this is getting missed out. Constantly there is revision, there is, there could be advisories through the Association of Investment Bankers, there could be observations on that particular deal. That's how regulatory changes have been made. Also, fundamentally, we are a disclosure based regime.
Right.
And we are also a prescription we have prescribed regulations.
Right.
But there is also intent of regulation. So, while the intent can't be written, it is something by practice either we pick up or the regulator points out.
Right.
So, we have to balance both those requirements.
So many of these new age companies, right, that don't meet these eligibility conditions now have got an easier way to access markets. So could you quickly tell me a little bit about that?
So, sir, SEBI as the regulations of SEBI enable all issuers to raise money.
Okay.
We have added protection layer for companies that don't have profitability track record.
Correct.
And that layer says, okay, I do not want to expose these companies which do not meet these criteria to a lot of retail investors.
Okay.
So, in a normal case or in a profitable company, if the retail portion is 35%,
right.
in these new age companies that do not meet these criteria, that is 10%.
Okay.
And that also is not mandatory 10%.
Okay. So you could have the entire issue
to
going
QIPs.
to QIPs. Okay.
Yeah, except that we need 1,000 allottees. But other than that,
right.
I think there is a lot more focus. Let the informed investors come in and let the retail come in some measure if they understand these businesses, or they come in the after listing when the proof of the pudding is for everyone to see.
So, so a company without a profitability track record can also now access the market, but it is only to the informed investors.
Yes.
So coming to retail investors and HNI investors, I mean, you've been saying that this IPO offer document is a 500-page document, 40 pages to 500 pages, I think is what you said.
Yes.
And I mean, I think it would be next to impossible for anybody in this age where attention spans are so short to read a 500-page document.
That's correct.
Right. So, if I may ask you, as an investment banker, what are those, key, 5, 10 things that investors must look at, before they, when they analyze, a company that is getting into the primary market? And as you said, all kinds of information, or literally every information that is important for making the decisions available. So what are those, few key things? That was one question that I had. And the second question is, you did say that, a large part of it, 50 out of those 500 pages are risks. So what are those key business risks that investors should, most definitely look at while, reading an offer document?
So, to enable retail investors to actually get capsule size information, there are 2 or 3 things we've already started doing, and I think this is work in progress.
Right.
One, right at the beginning of the offer document, there's a chapter called Summary of Offer Document.
Okay.
That gives you a bird's eye view of everything. What is the business of the company, which industry is it in, key financial information, key litigations, key business approvals,
and how many pages is that?
It's about 20 pages.
20 pages, okay. So that's readable.
That's readable.
Right.
Of course, there are some bulky sections within it, but
so it gives you all the key elements that any investor needs to look at.
It gives
and then you could go and further examine it in detail.
Now, if somebody wants to understand the financials in depth, then please read the MD&A section.
Correct.
That lays out your accounting policies. It lays out year-to-year changes and why they happen. It lays out what drives the company's cost, what drives the company's revenue.
Right.
The business section also, the first 3 or 4 pages actually has an overview, key strengths and strategies.
Right.
So again, that is 4 or 5 pages and can give a very good idea to a reader to understand quickly the business and the potential of how the business will grow. On understanding the competitors, etc., of course, there's the industry section which can be bulky, but there is a section called Basis for Issue Price, which lists down performance, financial performance and KPIs of your peer set.
Okay.
So again, that's another section that can be read. Along with the application form, we have something called the abridged prospectus, again an 8-10 page document that lists down these key parameters like the summary.
Okay.
We also now formally have something called an audio visual. that an issuer prepares with every deal, and it's a 10-minute audio-visual presentation covering all aspects of the offering.
Okay.
So yes.
And in terms of risks?
Risks, I think they are written in the order of materiality.
Okay.
So I would think the first 10, 15, 20 risks, if they have the patience, at least to read those.
Right.
Definitely read the headline, but the devil is in the details. So, you know, patiently go through at least the top 10 risks, I would say.
But there are some less obvious pitfalls also for, you know, retail investors. I mean, one obviously is the fact that, you know, as you rightly said, when the way you allocate shares, people may get, you know, a very small allocation, and therefore, you know, they may not look to hold it for the long term, and therefore many people are looking for, you know, listing gains and, you know, exiting those. And secondly, sometimes because of the lock-in which you talked about, if the QIB book is very big and a large part gets locked in for 90 days or whatever time it is required to be locked in, initial liquidity sometimes is a challenge. So how do retail investors or HNIs sort of face up to those kind of issues?
So we're seeing definitely a trend where retail is staying invested longer than before.
Yeah.
And I can share with you data from 7-8 years back where within 90 days of an IPO, the number of folios would shrink to by 90%, so shrink to 10%.
10%, right.
And we're not seeing those trends as stark now.
Right. Okay.
Yes, it is possible that you try to invest. So firstly, the volume of IPOs has increased. So, you know, there's more to choose from. Yes, it is true that the allocation methodology is such that you are getting only 10,000-15,000 worth of allocation.
Right.
We see investors wanting to add to it on listing.
Right.
We see investors holding on, and there is no, I mean, it really just also depends on that investor's mindset. Are they in this only for listing gains, or are they here as a long-term investor? Sometimes we do see retail investors taking a punt and going larger, making larger application size and coming into the HNI1 category where the minimum is 2 lakh rupees.
Correct.
So it is a combination of all of these things. But it is a fact that a large volume of people are only in it for trading gains.
Right.
They invest, they sell, they invest in the next IPO.
Right.
And it is becoming an important, it is also an important constituent in IPO subscriptions.
Right, I agree with you.
And larger IPOs are also timing such that, okay, we close this offering, T+2 the money is back.
Right.
And T+3 becomes somebody else's T.
Right,
you know?
exactly.
So
but then that's a very interesting observation that retail and HNIs are now, I mean, staying invested, which I think is a very, very positive
yes. And
trend.
also another important or changing factor is that the constitution of where the money was coming from has also been democratized. There are many, many states. I mean, I remember that 99% of money used to come from Maharashtra and Gujarat.
Or tier 1 cities also.
Tier 1, so Maharashtra, Gujarat, Delhi, Karnataka.
Right, correct.
But now we are seeing the UPs and the Bihars and the Madhya Pradeshs and the Rajasthan was also somewhat there, but now increasing in importance. So there is a lot more ease of doing IPO investing is of course something that may have helped, the ability of electronic platforms to exist.
Yeah, so that was the next question that I has. How has digital changed this entire space? One, you said penetration has increased dramatically. A lot more of the entire IPO process has now got digitized. Is that what you're saying?
Yes, 100%. Okay. And people
so 100% of the IPO process is digitized.
100%, other than till getting to due diligence and disclosure, which is a lot of manual process. But after that, yes, the execution process is quite digitized.
Okay.
But like I said, ability to invest is faster. You can actually, if you have net banking and you do a KYC for ASBA, you can go on your bank app and invest in IPOs in 3 seconds, literally.
Right.
The money will get blocked and your application will be submitted. So of course there's ease of investing. There is a lot more information available about IPOs. Tons of people have made money. That kind of encourages others to do it. So yeah, I mean, I think there's been a lot of.
And how has the NSE Emerge and the BSE SME platform helped in this?
I think they are focused on the SME leg
Right.
of
No, in terms
companies.
of the digitization process.
So their processes are very digitized,
Okay.
and therefore I think there's a similar ease, maybe a better ease for both issuers and investors on those platforms.
Okay.
But even in the main board IPOs, there's a lot of digitization now that has helped.
So, I had a last question for you, and that is, given that there is so much participation, and this participation now you're saying is coming from literally every corner of the country today. Whether it is the smallest city in Rajasthan or it is from a Bombay or a Delhi. So many of these investors, as you also said, seem to be chasing what do you call it, listing gains. They may not be really understanding the fundamentals. So what is it that you as investment bankers and we as people who are involved in capacity building should do to sort of make the community more aware in terms of investor education and help them understand the complexities of the primary market?
I think in the last 3 or 4 years, we've had till December, there was a period where everything was just going up.
Right.
And I think early part of this financial year, or this calendar year, did see the market correcting a little bit.
Correct.
A little bit because of global uncertainty, probably because of corporate earning risks, etc. And we did see that the market came off a little bit, or at least the exuberance kind of reduced.
Right.
And I think a lot of investors understood after a long time that yes, markets can go up and down.
Right.
And that wisdom will one come with experience, because however much I may tell somebody, look, equity market is risky,
Right.
please read offer document before investing, and please be mindful that you are not here just, it's not gambling really, right?
So we could keep telling investors read the offer document before investing, but we need to get them to read that offer document.
One is get them to read it, yes, and two, by experience themselves, that caution
Right. Okay.
will make more sense.
Right.
Right? In the sense that if I've been through it once,
Right.
I invested in something in January, it came off 20% or 15% or 10%,
Right.
then I am wiser in March
Right.
to know, yes, finally, like there can be a reduction in price.
And therefore, let me read the offer document.
Let me
more
read
carefully.
the offer document. Let me not invest in everything that comes my way.
Right.
Let me be an informed investor.
Right.
And I think between the regulators, the exchanges, institutions like yourself, the investment bankers, the association, there is a very concerted effort over a long period of time to tell the investor,
Okay.
you should be an informed investor. Please do not follow the herd. But yes, I mean, the best we can do is keep telling them that message and make sure that we are bringing good companies to the market. They are responsible. They give full disclosures, not only in the IPO time and even after.
Right. Thank you so much, Gesu, for spending this time with us.
Thank you so much. Thank you for having me, sir.